The signal is flashing red. The gold-to-silver ratio just dropped decisively below the 70 level. This is not market noise. This is a cold, mechanical alarm. This single metric defines the end of monetary illusion. It is the core systemic logic in motion. The paper structure is failing. Think back to 1991. The ratio spiked to 100 to 1. That was the height of fiat delusion. The market believed the promise. That period is over. History is not a smooth path. It is a recurring mechanism. Every time this ratio tightens, trust evaporates. The counterparty system is revealed as a fraud. Capital rushes for the exits. They are seeking physical reality. The speed of this latest drop is the key. The compression accelerates the schedule. We saw this exact pattern before the 2008 financial collapse. The ratio moved. Then the system broke. It is happening again, but this time the debt is far larger. This is the sound of the fuse being lit. The historical clock is ticking. You must pay attention to this metric. The gold/silver ratio is the ultimate measure of financial sanity. It is the history of money distilled into a single number. It tells you when the politicians' promises are about to break. The recurring mechanism for system reset is always the same. When confidence in the central authority is high, the ratio stretches out. Silver is treated as just an industrial metal. Gold is kept quiet in the vault. The promise is believed. When fear hits, everything changes. Capital flees paper debt. It stampedes toward tangible assets. Silver, because it is cheaper and more volatile, always moves faster than gold in the initial stages of panic. The ratio violently collapses. This is the market's honest audit of the system. Look at the late 19th century. The global economy was tied to gold. The stability was fragile. New silver discoveries were flooding the market. This led to massive political instability. It was a crisis of commodity versus currency. The historical peg was 15 to 1. Governments tried to enforce it. The market fought back. By the 1880s, the ratio was pushing past 30 to 1. This widening represented massive systemic fragility. Then came the inevitable. The panic of 1893 arrived. It was a brutal credit contraction. Banks failed. Railroads collapsed across the nation. The panic was not an accident. It was the mathematical consequence of ignoring the money supply imbalance. The ratio, previously manipulated, snapped. The subsequent depression was a decade of pain. That was the price of ignoring the historical pattern of metal. Move forward to the 1920s. A credit bubble fueled by false optimism. The ratio expanded again, sitting high in the 70s. This meant total faith in the newly established Federal Reserve. It meant total faith in debt. The systemic logic was already demanding a reckoning. The stock market peak in 1929 was the beginning of the end. The ratio had already signaled the shift. The ultimate destruction was the Great Depression. The banking system froze solid. Between 1929 and 1932, the Dow Jones Industrial Average lost a catastrophic 89% of its value. That is the first shock number. That is not a correction. That is total systemic erasure. At the depth of that crisis, the ratio violently compressed. It dropped briefly below 50 to 1. People were hoarding physical silver. They had zero trust in the banks. The system reacted with hostility. In 1933, FDR issued Executive Order 6102. It was a direct act of confiscation. The government made it illegal for citizens to own gold. The pattern is always the same. When people reject the paper, the state criminalizes the physical asset. Control is the only goal. The 1970s provide the clearest lesson. August 1971 changed everything. President Nixon unilaterally ended the gold convertibility of the dollar. The last physical link was severed. It was the ultimate political promise broken. The systemic logic immediately demanded inflation. The dollar was now pure paper debt. The market sensed the betrayal instantly. In 1971, the ratio was sitting near 40 to 1. By the mid-1970s, as inflation raged, the ratio was rapidly compressing. The oil crises amplified the chaos. The climax arrived in January 1980. That was the peak of the inflationary breakdown. Gold and silver prices exploded. The gold/silver ratio hit an extreme low of just 17-1. This is the second shock number. That compression was the market declaring the fiat experiment dead. It was a full-scale monetary revolt. That period was the painful inflationary reset. The period that followed was the era of debt expansion. The ratio expanded again. Central banks managed the illusion of stability. The market forgot the pain of the 1970s. This led to maximum financialization. The ratio peaked again around 1991 at that obscene level of 100-1. This is the third shock number. That number represents the maximum belief in leverage and derivatives. It was the peak of global fragility. Physical metal was dismissed as a relic. This massive spread was the engine for the next collapse. The global financial crisis of 2008 was simply the debt structure imploding. But the signal came earlier. The ratio was near 80-1 in 2003. It was already falling by 2007. When Lehman Brothers collapsed in September 2008, the ratio dropped sharply into the 40s. The entire structure of counterparty trust was instantly vaporized. The market moved from bank solvency to physical metal in a matter of hours. The ratio's collapse was the mathematical proof of the system's failure. It was the recurring mechanism playing out in real time. This is the unchangeable historical record. A violent drop in the gold/silver ratio is the non-negotiable signature of a massive systemic reset. The market always moves to physical first. The political promise always fails second. We are now living the next iteration of this cold, logical sequence. The gold/silver ratio has broken under the 70 threshold. This is the fourth shock number. This is the accelerated timeline. What defines this specific crisis is the scale of the preceding debt. The central banks learned nothing from 2008. They simply printed more. The debt is now the final nail. Global debt is now hovering near $300 trillion. This is the fifth shock number. That debt is the true definition of modern systemic fragility. This debt can never be repaid with honest money. It will be defaulted upon through inflation. The current pattern of ratio compression is driven by three modern, inescapable forces. First, the core inflation is structural. Forget the official CPI numbers. They are engineered to lie. The real cost of food, energy, and housing is demolishing the middle class. The dollar's value is being destroyed by design. This is what drives the demand for silver. Silver is real value. It is industrial value. As fiat fails, people must hoard tangibles. Second, the sovereign debt crisis is no longer future tense. It is now. The U.S. government is now paying record amounts simply to service the existing debt. It is a slow, structural collapse. This is the core of the systemic logic. Bond investors are realizing they are holding a promise that cannot be kept. They are subtly exiting the paper structure. They move into gold. Silver is dragged along. Third, geopolitical fragmentation is forcing the issue. The global de-dollarization trend is real. Nations are aggressively acquiring gold. They are rejecting the dollar's dominance. This is a direct loss of faith in the Western financial structure. When major central banks buy gold, it confirms the end of the current monetary epoch. Silver follows, amplified by its extreme historical undervaluation. This flight is a rejection of the global political promise. The systemic stress this time is multifaceted. It is not just one bubble bursting. It is the simultaneous failure of currency integrity, manageable debt, and geopolitical stability. The rapid ratio drop is the market discounting all of these failures at once. It is a faster, more violent move than in previous cycles. The sheer scale of the debt ensures that the coming reset must be equally violent. The modern mechanism of collapse is quiet. It is not a crowd outside a bank. It is the silent, insidious erosion of the value of your savings. It is the sophisticated destruction of the middle class through engineered inflation. But the signal from the gold/silver ratio remains loud and clear. The physical metal market is the only honest metric left. It understands that the debt is too large. It understands that the final repricing is underway. The promise of a stable dollar is a lie. The value is being withdrawn. This is not fear. This is the math being executed. The pattern is now locked in. The gold/silver ratio is below the critical threshold. What is coming is the inevitable completion of the systemic logic. There is no soft landing. When the reset phase accelerates, expect the final breakdown of confidence. All leverage will be exposed. All debt will be questioned. The contagion will be immense. Hundreds of trillions in derivatives rely on counterparty solvency. The failure of one major global bank will trigger a chain reaction. This time, there is no capacity left for the scale of bailout that will be required. The next failure will be the final failure of the central banking model. The current ratio compression will continue its descent. It will seek its historical equilibrium. This means a move that could revisit the 30-to-1 level from the 1893 panic. Could even go lower. This move will be absolute panic. It will be driven by the need for assets with zero counterparty risk. Gold is the anchor. Silver is the lever. Its volatility makes it the explosive element in the final flight from paper currency. The consequence is mathematical. A violent ratio compression signals the end of the fiat dream. There will be a brutal monetary reset. Everything will be repriced. It will be repriced against physical metal. Assets that rely on a promise or on a ledger entry will be wiped out. This is not about speculation. It is about preservation. It is about retaining real purchasing power. This systemic stress is the only thing that matters now. The disaster was planned decades ago. It was built on the foundation of endless printing and zero rates. The current ratio shift is the final warning. The recurring mechanism is reaching its breaking point. History shows no mercy. After this level of financial imbalance, the result is destruction of value. The debt is reset by chaos. The promise is political. The consequence is mathematical. This video explains historical and economic systems. It is informational, not financial advice or price forecasting. The gold/silver ratio is the cold, hard verdict on the financial system. It confirms the promise of stability is a lie. Confirms the debt is unsustainable. It confirms the systemic logic of collapse is now active. Every historical compression has been followed by an extreme reset. The acceleration is now underway. You have the data. You have the pattern. You know the inevitable consequence. Do not ignore this signal. The promise is political. The consequence is mathematical. No one escapes. You need to track the end of the current monetary era. Subscribe to this channel now. We document the inescapable collapse of the system and the recurring financial patterns that define it. Join our membership for deeper, actionable analysis of the final mechanisms that rule the shadow economy. Do it now before the window closes entirely.